Joining us right now to talk markets and much more is Abby Joseph Cohen. She is the former partner and chief U.S. strategist at Goldman Sachs, now a professor of business at Columbia Business School, and a very longtime friend of Squawk Box. In fact, I almost feel like Joe should be leading this off because the two of you were both there 30 years ago.
We were.
Through for this. You were a frequent guest from the beginning, Abby.
Yeah, I was 12 years old at the time.
Joe
was about 8.
Yeah, no, I was 61, I think. No, that's horrible. It's good to see you again.
Thank you. I'm delighted to be here.
We haven't changed. Neither one of us have really changed, I don't think, have we?
I don't know about that, but that's
who are you talking about? You or me? Yeah, exactly.
Well, Abby, talk a little bit about when you came on, because we were just saying, we have these IFB things we put in our ears to help us hear what's happening.
October 7th, 2024. I didn't know it had been that long.
But you had a special IFB that the Squawk team gave to you because you were on so frequently.
Absolutely. When Squawk Box started, I was given an opportunity to help explain markets to your viewers. And I guess the viewers responded positively, and I was on so frequently that I once walked into the studio and I was given the gift box that included my own personalized IFB, which is the earpiece. Yeah. So I felt like I was part of the team.
You're on the Legends and Icons and Legends with Jack Welch and everybody. Yeah, everybody has signed it. Jack Welch, Martha Stewart, Warren Buffett. Donald J. Trump, who signed it as well. Abby Joseph Cohen, L. Arian, Boone Pickens, the late, great Boone Pickens. Those are worth something now, Abby. I'll give it to you for a souvenir.
Interesting company to be part of, and I've been delighted to be part of your team over these many years.
As are we. We good? Over 46,000. We're going to 56,000?
At some point. As you know,
never say direction and duration.
That's exactly so. Mm-hmm. As you know, I'm a long-term bull on the United States. I think that our economy is by far the most impressive in the world, but there are always things to watch out for. And I loved watching the interview that you did yesterday with Lloyd Blankfein, because I have memories of sitting in a room with Lloyd, and we'd all go in, and everybody sort of knew what the consensus was and broad expectations in the market. But our conversation in that room was always, what are we missing? What could go wrong? And so if you think of a bell curve, the market tends to trade in the center of that bell curve, but the real opportunities and the real risks are at the extreme ends of that bell curve. And one of the things I'm looking at, quite frankly, because I like to be prepared for risks, is what's happening with the United States vis-a-vis China. This is a long-term concern. I'm worried, for example, about the way we seem not to be investing as much as we used to in science and technology and also education. And the Chinese are doing a blockbuster job in their own economy investing in these categories. So is this something that investors need to worry about this week? No, but it's something to keep on the radar.
Just wonder, we invest so much in education. Is it the amount of money, or is it if you keep doing the same thing that's not working over and over again, you got to change the thing you're doing?
Apparently, the money is not being well spent, because the pipeline that we have in the United States, K through 12, in math and science and so on, just isn't doing it for us. And we find that our PhD programs are very heavily filled by non-Americans. Now, this has been going on for quite a long time. We extend student visas to people, and fortunately, in the past, many of these people have stayed in the United States. 62 or 63% of the working PhDs in the U.S. in medicine and engineering and applied science are, in fact, immigrants, not children of immigrants, but immigrants. And it's part of the secret sauce. The U.S. has always benefited from immigration flows, going back, obviously, to the founding of the nation. And if we mess that up, and at the same time we are not enhancing domestic education, that is not a recipe for success.
People have been very concerned about the tariffs. I think Joe was mentioning you were one of them the last time you were on. That threat has not played out the way most people expected, certainly not the way the market was reacting back in April.
Right. Absolutely true. I was one of those who was extremely concerned about tariffs. And as I always do, I go back and say, have I missed something? And one of the things that we need to keep in mind is that the tariffs have not yet been fully implemented. We haven't yet seen the impact. Now, I hope that we, in fact, have what the consensus is saying, which is, basically a one-time increase in price level, but not in inflation. But we don't know that yet. And one of the things to keep in mind is that those one-time increases in tariff costs will be rolling. We've only seen part of it thus far. We'll see more in the second half of the year. And as all those inventories that got built up in anticipation of the tariffs get run down, we may see some cost increases as well as the supply chain disruptions. But if it turns out that I was unnecessarily pessimistic, I will be among the first to say it's okay.
Gary Cohn just explained it away by saying the companies have kind of been eating it themselves, the companies and the producers of all of these goods, because they're just not hiring as many people. They're letting people go through attrition and through layoffs, and they've gotten much more efficient at doing it themselves, which is great until you look at the jobs market.
It's great until you look at the jobs market. Also keep in mind that in the second half of the year, we may in fact see profit margin erosion because of the tariffs. And I am worried about the job market. I think Gary laid it out quite well. As an economist, I would also say that the arithmetic has been confusing a lot of people. If the labor force, the size of the labor force is no longer growing, that's the denominator of the unemployment rate, which means that U2 that we look at, that unemployment rate, unemployed divided by the people in the labor force, if that hasn't changed very much, let's look at the denominator.
Everything you've laid out makes me think you think stocks are overpriced here. Is that the right takeaway from your thoughts on this, or no?
I think that stocks in general are fully priced, particularly the market cap weighted indices. And one of the things that I always look at is the following. You can be optimistic about the fundamentals or pessimistic about the fundamentals, but as an investor, you have to ask the question, what is already priced in? And I think that for some sectors of the U.S. market, the good news is already priced in. There's some sectors where it's not fully priced, but clearly at these levels, which we are all enjoying in the market, there's less margin for error. If things don't go quite as well as the consensus expects, so for example, Joe, if inflation numbers do start to tick up, or if the labor data becomes less comfortable than it is right now, that could be a problem.
Where is the greater likelihood of trouble? I've thought for a while that it was growth in labor, not inflation.
I would agree with you, Joe.
Yeah.
I think right now the bigger concern is that things have slowed down.
Yeah.
We see it in the jobs numbers. We see it in the consumption data as well. And the other place we see it that many people are not talking about is business investment. We basically see that investment in equipment, investment in other categories related to AI have slowed. Now, they've slowed from torrid levels, so you couldn't expect those rates of growth to continue, but there has in fact been a slowdown. And in the second half of the year, we may see GDP numbers that are closer to 1.5% rather than 3%.
The market's current, everybody always says it's a sugar high, depending on their own point of view, but the sugar high could be rate cuts that are coming, and that's why we're up here.
That's why we're up
even though
here.
Growth is slow.
Okay, but if it's already priced in, then the question becomes, will those rate cuts be effective? And we don't know that yet.